Today we're looking at 6 undervalued dividend stocks near their 52-week lows to buy now. As always, we're going to look at their historical performance. We're going to run into their dividend safety score. We're going to take a look at some of their financial metrics. And as always, we will run them through the valuation model, getting to the intrinsic value as well as that acceptable buy price given the investor margin of safety, and finding out what Wall Street are forecasting for their price over the next 12 months. Let's jump into the first stock, which we have as Starbucks Corporation. Now they are down around 15% over the last year. They are trading right there towards that 52-week low with a yield of 2.5%, forward PE of just over 22. And for those who have been holding the company over the last 10 years, you would be up around 161%. Remember, it doesn't include those dividends reinvested, and we can see it did hit its high in the summer of 2021 at $126. So let's take a look. Dividend safety score 67. It is safe. Market cap 105 billion. It is a mega cap company. Now, in terms of those recessionary metrics, for those that see a recession inbound in 2024, while they didn't pay a dividend in 07-09, they had above average growth, -6% versus the S&P's -12%, but we do see they did underperform the S&P with a -69% recession return versus the S&P's -55%. Dividend growth, nice to see, 7.5% increase last September. That is above that minimum 4% we do advocate on the channel to get above to beat inflation. Over the last 5 years as well as the last 10 years, very strong double-digit growth every single year to the dividend. And we can see they have been increasing those dividends for the last 13 years. Now, in terms of dividend yield theory, as always, it states a company is undervalued when that current yield sits above the 5-year average. 2.46 versus 2.01, so we have our first sign of undervaluation. Forward PE 23 versus the 5-year average of 29. Again, a second sign of undervaluation. Do bear in mind though, we don't look at any of these models in isolation and we will draw conclusions towards the end. And we also note the consumer discretionary sector PE does sit significantly lower. So let's take a look at the free cash flow payout. For new viewers, we do ignore earnings. It is susceptible to manipulation by management through accounting. We focus on the free cash flow. Personally, my target is 60% or lower. If you want to be industry or sector specific, you can bring this down to 50%. 2022 was very high in my opinion at 90%. It's positive to see that 2023 did come down lower to 67%. 2024 expected at 70%, so I would like to see another high, strong single-digit dividend increase this September to Starbucks' dividend. Free cash flow per share, well, it's gone from -37 cents in 2014 to $3.20 in 2023, so that is positive to note. It has increased over the period, but again, it is very inconsistent as we can see here. We do note some years where we see tremendous growth, but then also tremendous negative growth, so just bear that in mind with this company. Their free cash flow growth is fairly inconsistent. Sales growth, well, nearly double-digit increases every single year to the top line. 2023, exactly the same, 12%, so very positive. We do have that justifiable drop for COVID year at -11%. And numerically speaking, we see it go from 16 billion in 2014 to 36 in 2023, so more than doubling their top line. If that wasn't enough, well, they also do share buybacks, returning excess cash to investor pockets. They've bought back a lot of shares, 1.53 billion in 2014, 1.15 in 2023. In terms of the ROIC, well, double digits, in fact, every single year bar 2020. Very positive, especially for my own investing thesis. I'll only invest if the company has at a minimum 10% consistent ROIC. This gives me faith management are able to effectively allocate their capital, and 33% in 2023 is positive to note. Operating margin, now this is one that restaurant industry does struggle. We do like to see 16% as the preference. Now year on year we can see it is pretty much there, although 2023 it did drop. Again, we see that notable COVID year, but as long as it is straddling around that level at a minimum, then that is something positive in my opinion. And free cash flow margin, more of the same. The last 3 years looking strong above that 5% minimum. Now when we look at the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, this signals essentially two things: dividend safety as well as balance sheet strength. 2023, 2.06 years, the number of years it would take Starbucks to pay all of their debt net of cash on hand. 2024 expected to go below 2. That is positive given the maximum we look for is 3.5. So the dividend does look to be safe. The balance sheet does look healthy for Starbucks Corporation. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button, and as always, let us know your thoughts in the comments as we go along. Now, typically on the channel, when we do deep dives, we do run through every single model, but for today's episode, we're going to jump straight into the intrinsic value, which for this episode for Starbucks does come out to be $110. Now, the current trading price, $93. Typically, margin of safety, we start off with 10%, which we use if we believe it meets 3 criteria. Essentially, a wide moat, strong set of financial statements, good forward-looking data, and that strong financial metrics. Now, 10%, we see a buy up to $99. At 15%, a buy up to $94, which isn't too far off the current trading price. At a 20% margin of safety, you can see you would be looking at $88. So right now for Starbucks, we see at least a 15% margin of safety based on our estimates and judgments. What do Wall Street say? Well, they forecast the share price to go up to around $113 over the next 12 months. So they see upside of 22%, and they do believe that Starbucks is a fairly strong buy. Now, before we jump into the next stock, just to let you know, we have released a new free weekly newsletter. Last week's episode was on undervalued companies with strong upsides. If you do want to take a look, do click on that pinned comment below. It is completely free to sign up, and every week we do have different discussion points. So the next stock we're looking at right there towards its 52-week lows is Pfizer. Now, this is one that has been hammered, down 38% over the last year. The yield now is over 6%, and we can see a forward PE of under 18. Now, if you have bought this company and held it over the last 10 years, you would be down 5%, and we can see its all-time highs at the back end of 2021 at $60, and now it is trading for less than half that. Dividend safety, well, 75, it is safe. Market cap, 155 billion. It is a mega cap company. Now, in terms of the key recessionary metrics, well, they cut the dividend in the 07-09 crash, above average growth, but they also outperformed the S&P with a negative 45% return. Just a few weeks ago, they did increase that dividend 2.4%. Now, it's not something I like to see purely based on the fact that we always say 4% as a minimum just to keep up in line with inflation. Otherwise, you are taking a pay cut and losing purchasing power. Although we do know the average over the last 5 and 20 years is above inflation. And just something to point out, they have been increasing those dividends for the last 12 years. Now, in terms of dividend yield theory, again, we see that sign of undervaluation. That yield is significantly higher than the 5-year average, but we note the forward PE, interestingly, is above the 5-year average of 12.1. And when we compare Pfizer to the healthcare sector PE, they are pretty much in line. Free cash flow payout, now 2022 came in at 34%. They haven't yet released their annual report for 2023, but this is what we call a red flag indicator, essentially alerting us to the fact that Pfizer are essentially going to be paying out more in dividends in 2023 than generating in free cash flow, so do bear that in mind. Free cash flow per share, well, 238 up to that 2020 pre-COVID year was relatively flat. We see they benefited heavily from COVID, hence why it did increase. But note, 2023 is expected to come down to 145. So something just to bear in mind and understand why the numbers are significantly higher over certain periods. And it is shown here with the sales growth. In fact, up to 2020, they did have a pretty poor increase to their top line. And also important to note, 2023, they are expecting a negative 31% drop to their sales. Numerically, then, we can see, whilst it has gone from 52 billion to 100 billion, 2023 is expected to be just under 70 billion. In more positive news, they do share buybacks, reducing the count from 6.9 billion to 5.72 over the last 10 years. ROIC, we note the last 2 years very positive in the 20s, although 2023, again, even though the top line is expected to reduce, it is still slightly higher than that minimum 10% we look for. Both operating margin and free cash flow margin very strong, very healthy, even post the COVID benefits they had, 26% in 2023, 12% on that free cash flow margin in 2023 as well. Net debt to EBITDA, well, pretty low in fact in 2022, 0.41, but just something to bear in mind in 2023's report and 2024 expected, it is looking to inch higher, but still below that 3, so for now it does look to be safe and the balance sheet does look to be in good hands. In terms of the intrinsic value, well, don't forget, as always, you can grab a copy of the valuation model to get to the intrinsic value as well as that acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. So margin of safety, we start off with 10%. We can see it is a buy up to $32, 15% up to $30, and when we go to 20%, we can still see it is a buy. At 25%, not just there yet, or in fact, we see around a 20% margin of safety for Pfizer. And when we take a look at the forecast, Wall Street are sensing a price target of $33 with upside of 19%, whilst also locking in a yield of 6% or more. Do let us know your thoughts in the comments whether or not you have been taking advantage of this significant hammering that Pfizer has gone through over the last few months. The next company we are looking at is Hershey Company, now down 14% over the last year, again right there at their 52-week lows with a yield of 2.5%, a forward PE just below 20, and over the last 10 years you would be up 91%, and we do see it heavily falling from that top that we saw in May 2023 of $275. Now dividend safety 93, very safe, market cap 39 billion. And when we take a look at those recessionary metrics, well, they maintain the dividend in the 0709 crash, above average growth, and also significantly outperformed the S&P with that negative 30% return. Dividend growth, very strong double-digit increase last summer, 9% over the last 5 years, and positive to see that double-digit increase every single year for the last 20 years. And they have not only been increasing the dividend for the last 13 years, but paying dividends for 93 years without a reduction. Now, in terms of dividend yield theory, we can see that undervaluation signal 2.51 versus 2.03, as well as the forward PE significantly below that 5-year average. In terms of the sector PE, though, it is more in line now with that consumer staples 19.2 PE. In terms of the free cash flow payout, well, it has been for the large part below 60% year on year. 2023 at 54% still looks healthy in my opinion. Free cash flow per share, nice growth over the period, more than double in fact, but again, we do see inconsistencies. It isn't growth after growth, so do bear in mind, while it does increase over the longer term, we do see years where it does fall. Sales growth the last 3 years looking very positive, with 2023 expected 11%, so that is nice to see. And numerically, we see the top line going from 7 billion to expected 11 billion in 2023. They also do share buybacks. They've bought about 10% of shares back over the last 10 years, consistently buying shares year on year. Whilst they don't buy a lot of shares, it is quite consistent, so that is nice to see. ROIC, double digits. In fact, from 2018 onwards, it has been in the mid-20s, so it's positive to see that consistency over the last 6 years. Operating margin, free cash flow margin, nothing really to note other than it is positive as it has been above the minimum levels we target, and in fact does look to be increasing over the period, and a similar story to be told on the free cash flow margins, so no real worries with Hershey's and both their operating and free cash flow margin. Again, very positive to note their net debt to EBITDA well below the 4 maximum for consumer staples and 1.51 expected in 2023. So in terms of the valuation for Hershey, it is the average of these 3 models for today's episode, and it comes to around $239. So a 10% margin of safety for Hershey would be a buy up to 215. Remember, this does come down to each individual investor's thesis. At 20%, we see a buy up to 190, pretty much at the trading value. So if you are happy with a 20% margin of safety, in our opinion and estimates, it would be around the current value of today's market price. In terms of Wall Street, their target is $233 over the next 12 months, so they do believe Hershey to be a buy with upside of 22%. We then move on to our first REIT in today's episode, Mid-America Apartment Communities. Now they are down around 20% over the last year. They do have a yield of 4.5% with a forward P to FFO ratio of 14. If you've been holding this company over the last 10 years, you would be up 103%, and we can see their all-time high, the back end of 2021 at $229, around $100 more than the current value. In terms of dividend safety, well, 97, very safe. Market cap 15 billion, a large cap company. Those recessionary metrics maintained the dividend during the last recession, above average growth and a near S&P return at negative 51%. They have at least been increasing those dividends around inflation or above over the last 5 years as well as the last 20 years, so that is at least positive to note, whilst getting a fairly decent starting yield, and they have been increasing those dividends for the last 12 years. In terms of dividend yield theory, again a massive sign of undervaluation, 4.49 versus 3.19, as well as that forward P to AFFO, 15.9 versus 21.4, and we can see though it is slightly higher than the real estate sector P to AFFO at 13.9. Now with essential REITs, we don't look at the free cash flow, it is more volatile, so we do focus on the adjusted funds from operations. Below 90% is the maximum we really want to see, and it's nice to note 2022 at 61% and 2023 expected 65% does look healthy for this real estate investment trust. Adjusted funds from operations pretty much doubled over the last 11 years, 433 in 2013, 834 expected in 2023. Again, not very consistent, but nonetheless it does move in the right direction over the longer term. Sales growth in pretty much double digits every single year or every few years to note, 2022 at 14%, 2023 9%, and there are some years where it at least keeps up in line with inflation. But one thing to note with REITs, we do look for 5 to 10% year on year as opposed to typical companies 3 to 7%. So we do see their top line has gone from 640 million to 2.13 billion expected. Now with REITs, very typical, they do rely on issuing equity as they do retain a little of that internally generated cash flow. So this is very common to see, 53 million to 116. But we do know this is one of those REITs that does dilute your position at a much slower rate than the other typical ones such as Realty Income and Vici Properties. ROIC 3 to 5% is the essential criteria for REITs, and we can see over the longer term it is looking very healthy, 4% over the more recent period, with 2022 and 2023 expected 6% looking very positive. Operating margin, very nice to note, it is increasing over the period, and 31% and 32% in 2023 is healthy for Mid-America Apartments. Now, when we're looking at the net debt to EBITDA, 5.5 is the maximum we want for REITs, and it's very nice to see it has been decreasing. 2023 at 3.38 is very healthy, and we can understand why we see that very strong dividend safety score. So let's jump into the valuation of this REIT, and as always, we don't use Graham's valuation because it isn't appropriate for the way REITs are structured. So our intrinsic value comes to $171. Now, let's use our margin of safety of 10%. It is a buy up to 154, 15% up to 145, 20% up to 136, and we can see it isn't quite there yet. So we believe there is around a 20 to 25% margin of safety. In terms of Wall Street and their price target, well, they have that of $149. So they see upside of 14%. So this does look to be one of the most undervalued REITs out there, in my opinion. And Wall Street have a fairly healthy upside as well. We then move into a completely different industry. We have the tobacco industry with Philip Morris. Now they're down 13% over the last year with a dividend yield of just below 6% and a forward P of 14.82. Over the last 10 years, you would only be up 16%. Again, it doesn't include those dividends reinvested, but it hasn't been the greatest return for this company. Dividend safety does sit at 64, so it is safe. Market cap 141 billion, mega cap company. Key metrics, well, they increased the dividend during the last recession, above average growth as well, so that looks to be fairly positive. Latest increase, not the greatest, that is below inflation. Remember, last 5 years as well as the last 10 years looking slightly bigger, so don't expect with this company large double-digit increases. Always good to understand the type of companies and have realistic expectations. 14 years of increasing that dividend as well. Dividend yield theory, we can have that, see that sign of undervaluation both on the yield as well as the forward PE. And when we compare it to the consumer staples, Philip Morris is sitting below. In terms of the free cash flow payout, below 85% for tobacco companies, they do typically pay out quite a significant amount. 2022 at 80% is acceptable. Just bear in mind, 2023 104%, they are expecting to pay out more in dividends than generating free cash flow. In better news, they are expecting to bring this down to 82% in 2024. Free cash flow per share, don't expect a lot of growth with tobacco companies, but over the longer term it has been increasing, which is positive. But again, bear in mind, 2023 we are expecting a drop to the free cash flow per share number. Sales growth, this will be typical of the majority of tobacco companies. It isn't fast growing. In fact, they do sometimes struggle just to keep up in line with inflation. Although in positive news, 2023, 8% expected to the top line increase. And there we have that numerical numbers, 31 billion to 34. They have also done share buybacks, although not consistent at all, but they have bought back around 60 million shares, in fact 70 million over the last 10 years. In terms of ROIC, we do find it very typical to be very high in the tobacco industry, hence why we see the above 15% for the ROIC. It has been decreasing, which is a slight worry, but it is still very high at 28% in 2023. Both operating margin and free cash flow margins looking very strong, very healthy. The only thing I would point out, they do look like they are starting to decrease, so something I would keep an eye on if you were an investor or a potential investor. And this is one thing why we do see that dividend safety score not sitting at very safe. They do have a fairly high net debt to EBITDA, 3.15 expected in 2023. Now, in terms of the valuation, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety at 10%, we see a buy up to 93.55. At 15%, it isn't quite there yet, so we see around 10 to 15% margin of safety for Philip Morris, which does offer a fairly decent starting yield. Wall Street, however, do see very strong upside, in fact above our intrinsic value at $110 with upside of 21%. Do let us know if you have been buying any of these or even tobacco companies, as they do seem to all have taken a massive hit over the last year. We then move on to stock number 6, which is Bristol Myers Squibb, down 32% over the last year at their 52-week low with a yield of just under 5%, a forward PE of below 7, and over the last 10 years they are pretty much flat. We see their all-time high not too long ago, in fact at the back end of 2022 at $81. Now, dividend safety is looking good, 70 it is safe, market cap just over 100 billion, a mega cap company. In terms of the key metrics, well, they maintain the dividend below average growth, but they did significantly outperform the S&P with their negative 32% return. Pretty decent in my opinion, 5.3% dividend increase just a few weeks ago, 7% over the last 5 years and 3% on average over the last 20 years. They have also been they have in fact increased their dividend over the last 16 years, but also been paying dividends for 52 years without a reduction. We can see a heavy sign of undervaluation on dividend yield theory, 4.83% versus 3.15%, as well as that forward PE significantly lower than the 5-year average. And when we compare it to the healthcare sector PE, Bristol Myers is much, much lower. So in terms of the free cash flow payout, in fact, pretty good news in my opinion. Over the last 6 to 7 years, very low. 2023, more of the same at 42%. 2024 expected 33%. So very positive. I would like to see a high single-digit increase to the dividend this year for Bristol Myers Squibb. 2013 to 2022, very nice growth over the period, around 3 times, but it is also important to note it isn't that consistent. Some years you do have negative growth, in fact year on year, so just bear that in mind. As I mentioned throughout the video, always understand what you own and why you own. Sales growth, very inconsistent as well. Some years of strong double-digit growth, some years where it is negative. 2024 and 2023, in fact, expected to be negative 4%. So numerically speaking, 16 billion to 45 billion. Shares outstanding, bit of a shame. We do see the opposite. They don't do share buybacks, or they have done over the period, but the net position would be net share dilution, as we can see 1.66 billion to 2.1 billion. ROIC not looking the greatest. It was very high over a few years. It did then drop, but it has started to pick back up. 12% expected in 2023. Operating margin and free cash flow margin for biotechs, we do expect these to be significantly higher. Bristol Myers have struggled continually, so do bear that in mind when you are factoring your own investment thesis for BMY. On the free cash flow margin, more positive news. Over the last 6 years, it has been pretty strong and pretty consistently above 20%. Net debt to EBITDA 1.5 is the preference for biotech companies. 2022, whilst it is pretty much straddling, 2023 we do see it go above. So just a few things to bear in mind when you are looking at BMY, as well as considering your margin of safety. So the intrinsic value for today's episode of BMY is coming to $71. Now let's start off with our margin of safety at 10%. It is a buy up to $64. 15% up to $61, 20% up to 57, and we can see there is some heavy margin of safety with this company, pretty much around 30%. But as always, it really depends on the investor that you are and what reasons you believe for the margin of safety. Wall Street, again, another strong buy. They see upside of 24% over the next 12 months with a price target of $62. As always, though, let me know your thoughts in the comments below. Are you buying any of these stocks, or are they any of these on your radar? Don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and your watch list by clicking on the pinned comment. And as always, click on that free newsletter link below if you do want to have these newsletters delivered to your door every single week. Last week's topic was a deep dive on a strong undervalued company with some strong upside. As always, have a great day. If you enjoyed today's episode, do smash that like button. Do subscribe if you want more of the same content. I'll see you all on the next episode. And as always, have a great weekend and take care.